Okay, ladies and gentlemen, you're all welcome for this meeting, and we're glad you made it in time. As you all know, the Eastern Ugandan community is a small community. We can't be compared to the other communities that are existing in the city of Eastern. I would like to encourage you, if you're not, if there's some noise in the background, please just mute. And so because of being a small community, we haven't taken advantage of a small community, because usually small communities come together and they do a lot of stuff together before they expand. But we haven't taken advantage of that. And as we grow, if we haven't built up something to work together, it's going to continue in the same manner. And so in this aspect, when we begin a meeting like this, we want to all come together to start working together. I know we have done so well when it comes to funeral. That's the only time we can come together very easily. But we can't be waiting for that. We can do that as during these developmental meetings and any other social meeting that we have. And we are so grateful for the members for participating in the WhatsApp group. We're so glad that a lot of people are doing some good job. They're participating in it. And that's very good for our community. As we begin, we want to emphasize something which you might be hearing it for the first time, or you've heard it before. We are referring Ugandans who live in Houston as Ugandan Americans. So regardless of the way you are here, what status you are in, whether a student, you are referred to as a Ugandan American. So you are in a Ugandan American community. Because we cannot refer to you right now as a German Ugandan, because you live here, you pay taxes here. That's why a man called Tamale Mirundi said, Ugandans, when they want to get good education, they go to the UK. When they want to make money, they go to the US. And when they want to go for vacation, they go to France. When they want to do shopping, they go to Dubai. But when they die, they want to be buried in Uganda. I thought that guy made sense. So for us who are here, we're making this home, and that's why we are discussing real estate, how to put your foot on the ground here. And so that being said, I would like to request somebody to open with a word of prayer here. Mr. Chairman, do you want to do that and open with a word of prayer briefly?
Let's pray. Father in heaven, we thank you for this time that we can gather together as members of the Ugandan Christian community. We ask, Almighty God, that may your hands be present wherever we discuss this evening, Almighty God, Father. We commit those who are unable to make it into your mighty hands, the Lord God, Father. You hasten their steps, Almighty God, Father, and enable them to join us, Almighty God, Father. We ask for your hedge of protection upon each one of us and all the families around. And also like to remember those going through the hurricane. Father, you protect them, Almighty God, Father. And this meeting, Father, may your name be glorified. In Jesus' name we pray. Amen.
Amen. Thank you, Mr. Chairman. And quickly, we're going to begin straight away with, we have 3 panelists with us. We have Patrick Wandera, and then we have Ernest Kalibara, and we have Joshua Kisuli. And we're going to allow them to introduce themselves briefly as we go on. So quickly, we'll begin with Patrick, and then Ernest, and then Charles, Joshua. Sorry about that.
Yes, committee. My name is Patrick Wandera. I've been in Houston for over 20 years. I'm a realtor or a real estate agent and a mortgage broker. I'll be happy to present whatever I could so that all guys can hear what I can give. Thank you.
Good evening. I hope everybody can hear me. I had a problem with the power here at my office. But my name is Janis Cabral here. I've been doing real estate for 12 years. I'm licensed to do real estate in the state of Texas. I'm very grateful for the time you've given me to be on this forum, and I hope I use some of my time and your time to get to know you and to answer some of the questions you might have. Thank you.
Josh, we can't hear you.
Josh, unmute your mic.
Josh? No, we can't hear you. Unmute.
Joshua?
Can you hear me now?
Yeah, that's good. Thank you.
Okay. All right. Sorry about that. I'm playing around with two gadgets just for resilience purposes. Again, my name is Joshua Kisuli. I've been in Houston from 2005. For the longest part, I've been doing the back end of real estate, mortgage servicing, and banking. So I've been doing real estate for the past 1 year, and I'm with Abbey Realty. So I have a blend of experiences, the front and the back end of it, and I'm excited. I'm here. Be more than glad to help you with whatever questions you have, share any experiences, and hopefully we can move some pins for some members in here.
Thank you, Josh. Ladies and gentlemen, without wasting time, we want to go straight to the program. We had some bit of technicalities to decide on the topic and the way to handle the topic, because it's widely spaced and we cannot complete everything right now. But what we're going to do, we're going to start with the step by step as was written there towards real estate ownership. But it's going to be general. So we're going to stretch from apartment complex to commercial, whatever it is. But in the meantime, we're going to give a chance to the realtors to give us what do we need as people who are living in the city of Houston and somewhere else. What do we need to prepare? What do we need to have? And what step do we need to take to own a real estate in the city of Houston? And I would like to give our brother Patrick Wandera, if you can take on that, it will be good for us.
Thank you very much, panelists, for giving me the first option to give in my views. For everyone who wants to own a home in Texas, there are several things that you have to go through. First of all, you have to determine whether you want to rent or you want to own. I know most of you do rent. So at that moment, you have to look at yourself and say, hey, I've been renting. What's my next step? Would it be trying to own a home, trying to own a condo, trying to own a townhouse, or even trying to own land? All those are categorized into real estate. So having gone through that, you decide, what should I own? Should I own a condominium? Should I own a townhouse? Should I own a house, or should I own land? All those things have different options. For example, what is a condominium? A condominium is just like a townhouse. The only difference is individually owned. Meanwhile, the apartment is owned by management or is controlled by management. The townhouse is controlled by the association. From there, what you're buying is only space. If it is a 4-story condominium, you only own space in between the first floor, second floor, third floor, and fourth floor. In case something happens to that space or it gets burnt, you only leave. The insurance company may pay you for that space, but you cannot say, I'm taking the building with me. Next thing is a townhouse. What you're owning between a townhouse is the walls between your neighbor to the other neighbor. So in between the walls is what you own. Again, something happens to it, the insurance company may only pay you what's in between that walls, and the land belongs to the maintenance. So the third one is a home. On a home, you own the building, the land on which it's sitting, but you don't have rights to the mineral that are underneath that home. So at that moment, you own everything. It's your private property. You have the right to defend it in case something happens to that. So before you get to that, the most important thing is to determine whether you can afford to move from an apartment to a house. So the most important thing is your credit score. In America, everyone should try to establish a credit score, a good credit score. Minimum would be 500 onwards, but the higher, the better. So there are 3 bureaus, there are 3 credit companies that offer credit union. That offer credit score. There's TransUnion, Equifax, and Experian. So what's the credit score? A credit score is just a numeric expression of someone's credit file. And how do you get that? Once you get in here, try as much as you can to establish it by opening up accounts in different stores, credit cards, banks. And how do you do that? You start by buying little items in the store, and once you start making payments to that, they'll give you a score. Apply for some credit cards. If they cannot give you those credit cards, go get what's called a secure credit card. For example, go to Chase, if that's where you bank. If they can't give you a credit card, ask them to give you a secure one. You give them $200, $500, and they'll give you a credit card for $500. There are some other companies like OpenSkyCC.com. Give them $500, they'll give you one for $500. You can open up 3 to make your credit go faster. So once you open up 3, 300, 300, 300, they'll give you 3. Now, once they give you those 3 cards, don't go and spend everything because they gave you 500, you spend the 500. No. The credit bureaus will look at it like, oh, this person is living on credit. So the rule of thumb is spend about 30% of what they gave you. If they gave you 500, spend about 150. At that moment, they are required by law to report every month to the credit bureau. So if you make normal payments and you didn't have anything, the first thing they'll give you 620 or 640. At that moment, you start moving on. So if you make your payments on time, you'll keep on going up, going up, going up, and eventually you'll end up in having 700. So at that moment, hey, you start saying, oh man, my score is very high. So you keep that at par. Next thing is look at your income. Make sure you have enough income that's gonna buy what you are trying to buy. which is a home, a townhome, a condominium. Then on that, make sure your employment is stable. Lenders are going to look at it that, hey, this person is stable because they are going to look at 2 years of employment. If you are stable in those 2 years of employment, that's good. One will say, oh, I was working for this company, but I moved this company. That's fine, so long as it's 2 years. But don't be, I'll give you an example. Don't be a teacher, then go move and be a mechanic for someone. They look at those as being two different kinds of employment. So they want it to be stable in a particular company. And once you are stable in a particular company, so they look at that as being good. So after having saved the down payment and the closing cost, you're going to start up by going to look at the lender or someone who's going to give you the money. So you give in your income, your W-2 forms, and they run your credit. Once they run your credit and it's good enough, yeah, they'll be able to give you a loan so that you can go use that loan for buying a house. Now, what is involved? There's a down payment and the closing cost. So don't think that, hey, once I put down 5%, that's enough. There will be some closing costs associated with the purchase of a house, which you have to put according to what kind of loan you are applying for. And what are the kinds of loans that are there? I mean, there's FHA, Federal Housing Administration. Down payment is 3.5%. Credit score starts from 580 onwards. There are people who say, oh, they told me they can give me 500. Yes, but you're going to put down a larger down payment. So you have to work to your credit score so that it goes above 580 to get the 3.5% down. And at that moment, you can also ask the seller to give you what's called closing cost, which they can up to 6%. But that will depend on your realtor to ask the seller. They are not required to give 6%, but yeah, you ask them, hey, they may end up by giving you 3%. At that moment, that 3% will help you with your closing cost. Next one is, that's one of the loans. The other one is a VA loan. If you're a veteran, yes, you can get a VA loan for 0% down. And on that one is 500 minimum score onwards. The third one is a USDA loan. USDA loan is for the rural community. 0% down, minimum score is 640. That's for the government loans. Then you have what's called conventional loans, which is Fannie Mae, Freddie Mac. Those are usually 5% down, minimum score of 620 onwards. But that one's going to depend on the desktop underwriting, which is the system that is used to see if you can qualify. Desktop underwriting is a system that was brought up by Fannie Mae. Freddie Mac is given to the lenders so that once you enter your information in there, it's going to spit out and say, yes, we're going to take them. It's DU eligibility. At that moment, you get that paper and send it to any lender, and the lender will take your file. On that one is 3%, it's 5% down. Maximum seller contribution is 3.5. 3% seller contribution. If the seller contributes 6%, they are not going to take that because their maximum is 3%. So what's going to happen with the other money is going to be given back to the seller, or they're going to reduce your loan. That's Fannie Mae. Fannie Mae also has some subsets, which is Home Ready. Home Ready was brought up to merge with FHA, because conventional loans say that, oh, most of the buyers are going to FHA because they have lower down payment. So Fannie Mae also devised up their Home Ready or Home Ready to try and match up with Fannie Mae. Home Ready is 3% down, but has other guidelines. One of the guidelines is income-based.
Okay.
Yep.
Oh, that's okay. But now we watch it because now we're going to lose out on the step-by-step that we are following. Because you have given us a lot of information. We wanted to where they can know that we're going to start with A, we're going to go to the second one and that. Because now when we get into the financing, the way it is, the Fannie Mae and all those people will end up being confused at this moment. But that is okay. So what we do, we'll follow up on that. What I wanted to bring Josh here to let us know, to let us know in the step-by-step. When you come, do we start with getting the house, or do we start with the financing, like with the mortgage paper that you're talking about? Josh, are you able to take on that?
Yeah, thank you, Jimmy. And I'll revisit some of the points that Wandera hint on. Again, on the roadmap, you talked about the roadmap to owning real estate. I think that the key things are commercial or residential. Typically, I think for our community, we're more likely to focus on residential real estate. And by that, I mean just beginning out with your first home, you know. But for the most part, we always start out with apartments, you know. So it's always good to start with the apartment because it helps with building your rental history. And, you know, he talked about credit score. So, you know, be in your apartment for a couple of years, 3, 4, 5 years, but then you should have a solid enough credit score to help you move on to the next step. So, of course, the next step, again, like Patrick said, it's getting into a house, you know. So getting into a house, of course, you want to watch your credit. Right now, 620 is the magic number. 620 and 580. He talked about the different parameters. So, but the key thing here is we have to watch our finances, because many times we're scared of moving out of our apartments and we don't know what it takes to move into a house. So most times I tell people that, you know, get pre-qualified, because everyone works in the U.S. Everyone works in the U.S. There's no way you can survive in this system without working. So that's the quickest way to find out whether or not you can actually become a homeowner, you know. However much money you have, if you don't have a pre-qualification, because you don't want to waste your time, you don't want to waste a realtor's time going house shopping before knowing how much actually you're eligible. So you need to know how much the lender is willing to lend you. And that's where the credit score comes into play. You know, credit score basically determines the cost of you borrowing the money. And that's where you watch it. And it brings me to another point too. I've met a lot of people who stay away from credit. Like, I don't want a credit card, I have a good credit. So this is how credit works. If you have a zero credit, there's nothing being reported on your credit. Okay, it's a point system. So you have to get some kind of credit like Patrick talked about, you know, be it a secured card. So these agencies have some reportable information, and that's how you build your credit. Okay, if you had a credit card and paid it off and didn't use it, your credit is going to be stagnant. Okay, and that's not good for you. But of course, watch how you use your credit. Okay, so it's a blend basically. Get your finances in order, have your employment, and then find a lender. There's so many lenders out there. Okay, find a realtor. I mean, on this forum already three realtors here. Okay, associate yourself with a realtor, and then find a lender and get pre-approved. What is pre-approval basically? When you go to a lender, they're going to take like a quick snapshot of what your finances are. They'll ask you, hey, Mr. Jimmy, how much do you make? You know, what are your debts and your liabilities? Which is another key factor here. your approval depends, they call it a debt to income ratio, okay? It has to be a certain percentage. I think it's 43%. Your debts cannot be so much over what you make, okay? They have the housing ratio, and then they have the general debt to income ratio. So those are the things you want to watch. You want to make sure that your debts are way less than how much you're bringing in, because those are the factors that are going to affect you moving from an apartment to a house. And then after that, of course, there's the investment part of it. You know, let's assume you're already a homeowner, or even you're an apartment owner, but you're not interested in just being a residential owner. You're okay being in an apartment. There's an investment aspect of it. Okay, the criteria is pretty much the same. The rates and the interest rates and the lending. There's some creative financing on that side, but it's the same pre-qualification process. They still have to look at your income. They have to look at your debts, your assets, and all that. So that's the holistic picture, basically. It's a game of how much you make, how much do you owe, and what your credit score is.
All right. Thank you so much, Josh. Well, let me bring Mr. Ernest Kalibala here. Mr. Ernest, somebody is in the city of Houston, and you're walking in a neighborhood and you see homes for sale and you like that home. What's wrong with somebody discovering that house, and then he knows the amount of money that is being asked for, and then you go to the loan officer to begin preparing to get your mortgage? What would be wrong with that in comparison to going to the lender to get the pre-qualification? What would be the problem in that?
Okay, thank you for the platform again. Let me first disclose this, that I'm a real estate agent, and I cannot talk about financing because that's a different license. Yeah. Now, let me take you back a little bit. If you do that, what you just said, you may find yourself disappointed that maybe you don't qualify for that house. So, but going back to what we're talking about, there is a question which a lot of people ask. What if I don't have credit? What if I don't have a steady job? That means I cannot buy a house. That means I cannot buy real estate. And the answer to that one is, the answer to that question is you can buy real estate even without a good credit. You can buy real estate even without a steady job. And as we continue to talk, we can go into details about how you can do that. One simple way of doing it is for somebody, for example, staying in an apartment, you can own real estate. You can get the owner to finance it for you. And most owners don't look at credit. They're going to look at the money you have to give them.
Right.
Somebody who wants to buy land, like here we have a lot of churches coming up. You can own land. The owner, you can put 50% down, and the owner can finance that for you. You don't have to worry about credit. Some people don't have papers, and they want to own real estate in Houston. The answer is you can do all those things. You just need to get together with your real estate agent.
Thank you. Let me bring somebody who is not a realtor here. Let me bring Godfrey. Godfrey works with the lenders and the financing institution. Godfrey, I wanted to find out how, when you're looking at the papers presented to you, the loan officers have presented you with the papers. When you're looking at them, what are you interested in? Are you looking at the person who is going to pay or to continue paying? Who probably is going to be foreclosed? Is that a good thing for your company or for this person who is trying to get this house? What are the pecs that you are looking for in that application?
Thank you all for disclosure. So I'd like to disclose that I did underwriting some time back, a couple of years ago. But basically, when you look at underwriting, it's what Josh, Wandera, and all have highlighted upon, is that your credit score. That's the first thing you look at. There are about 5 steps. I look at your credit score. Then the credit score takes us to your credit report. That's the next thing we look at. That's the underwriting process. Then the property you're going to buy. Because I don't want to give you money for you to go and buy it down. There's a special business. People who deal in that kind of dilapidated buildings. But then the next thing else I'm going to put into factor is, are you going to stay in the house? If it's a personal residence, those are other factors also that I put into the underwriting process. And the next thing that also highlighted was the debt to income ratio. That is also a factor that is put in. Then the next thing we're going to look at is going to be your collateral. And that again goes back to money. I think Josh highlighted that. How much money do you have? How much down payment do you have? And I think Patrick also mentioned something of the finances, that you can get a house without a credit, without having a credit report. That means you have a lot of money. And that also determines if you're going to put a lot of down payment down, that means you're going to end up with a conventional loan. Then you avoid paying there's some additional costs you pay monthly. If you're going to get an FHA loan, anime loan, additional insurances that you have to pay for. So all this put together helps. Another factor also I'm looking at will be amortization. Are you going to get a house for 15 years or are you going to get a house for 30 years? Those are all the factors that I put into consideration before in the process of underwriting of your loan. Next, I think I talked about the financial reserve. And lastly would be the loan to value ratio also. That is also something looked at. That means the value of the house and how much you're going to put down to reduce the principal. That also determines whether you're going to end up with a conventional loan or you're going to end up with the government agencies. That's Fannie Mae, Freddie Mac, and FHA loans. So all those holistically are put together to determine how much money you're going to get. Now you talked about foreclosure. Foreclosure is good for some business, and now that's beyond what we're discussing today. It's good. Some companies look to that, actually thrive on foreclosed houses. Then there are those who, because the only person who can hold mortgages for 30 years, who can give you money for 30 years is the government. So practically the government is the only person who can do that. Private lenders or private companies, what they do, there are different ways, there are different ways you can package a loan. So the foreclosure aspect at this stage for us, we'll leave it aside, but based on all the factors that have been listed by our realtor professionals, upon fulfilling all those factors, it's easy for you to get a house. Another thing, looking at a house is actually an investment. It's what I tell everybody. If you're renting, to me, you're throwing away money. If you own a house, you're investing in yourself. Because every time you pay that money, you're reducing your principal. And let me say you're ready to fly to Uganda, you sell your house. That money you paid, you can get it back as in form of equity. And that is cash in your pocket, and you take your flight home. So real estate is a very good thing. Thank you.
Jimmy, let me just chime in a little bit on what he said. So we've been talking about credit score. So let's say you go for pre-qualification and you have technically a bad credit score or you haven't been approved. It's not the end of it all, okay? There's credit restoration agencies, businesses, and companies that can fast track you and help you get in shape. So maybe in a couple of months, they look at your finances and help you basically build that credit back. So I've seen some people who get shut down and they call it quits. It's like a death sentence. So don't shy away. It's a good thing, actually. They're telling you that, hey, this is what you need to do to get in shape, to restore your credit, and maybe in a couple of months, we can approve you for this. And then the other thing is let's not shy away from using realtors. What I want members to understand is anytime you're buying a property, it's actually the seller who is paying the realtor. And there's advantages in using a realtor, okay? You talked about dilapidated properties, okay? If you went in all by yourself and you're trying to get a property, there's some privy information that realtors have that you may not know. For example, Zillow, you know, anyone can list their property on Zillow, and their actual value may not be the actual comparative value in the neighborhood, you know? So there's flaws in that. And what happens is people who list their properties on Zillow, they end up having those properties for way longer period of time. And guess what happens? Once your property has been there for a longer period of time, people start eyeballing you, lowballing you, because they think something wrong with that property, okay? So don't shy away from realtors, okay? Realtors will help you discover things. You talked about seller concession, you know, someone having a seller pay towards some of your closing costs, okay? Realtors know how to go in and talk to the seller, be like, hey, we want to buy this house, but can you give my buyer some closing cost concessions, okay? And then lastly, what Godfrey talked about, the advantages of buying a house, you know? You're building equity, but the cost of borrowing against your house is very cheap, you know? A regular credit card is around 17%, okay? If you borrowed against your house, let's say you had debts, student loans, whatever, okay? If you went to a traditional lender, you might probably pay 17, 18%. But if you borrowed against your house, you're probably looking at a rate of around 3%, okay? So there's so many advantages in doing that. So I'll yield back.
I'll add on to that, what they just said. Yes.
Okay.
If you're a renter, you're really dropping your money into the water, nothing coming up. But if you own a property, you're building equity, is an investment to you, and you get a tax bracket, tax breaks. When you file taxes, you can write off certain things. You get homestead exemption, especially in Texas. You get what's called homestead exemption. Another thing is shows stability. If you have two people, one has an apartment and buys a car, and one has a home, the person who has a home is considered more stable, and he will get more credit from different companies because he's stable. Two, someone may say, oh, you know what? I have an apartment, I can move anytime I feel like. Fine. The person who has a house can also move. Hey, he can start moving, I'll rent my home, which I bought in Texas, and I'm gonna move to California. So long as he puts a renter in that house to generate income, hey, he's building income while he's away. The other thing, yes, you can own a property and rent your bedrooms. So you're gonna pay off your home in less than 30 years if it's a 30-year mortgage, or in less than 15 years if it's 15 years mortgage. The only difference we have in Texas, we are so private, we do not want to do certain things. But I see some people who are coming up and they are learning from those who are in the northern parts that, hey, you buy a house, you're paying $2,000 mortgage, you have 4 bedrooms, you rent 3 bedrooms to students, or some other companies like A&B, you rent them on a monthly basis, you collect money, and in turn you pay off your home as fast as you can. So all those are really advantages for owning rather than renting. Thank you.
Let me bring Patrick here. Patrick, if somebody is living in an apartment right now and they have a lease for about, say, the lease is expiring in about 6 months' time, and this person is ready to move out, or should this person wait for those 6 months to expire before they go to the new house that they are going to? That's one. But two, also, where would you direct them to go in terms of the location? Are you going to look at where the Ugandan American community is, where you're going to drop them, or what are you going to do with them? So there's a question for you there.
Yeah, basically if someone is in an apartment and he has some months to go, that's fine. He can start looking. When he has 4 months, he can start looking. If that's hard, if he can convince the management company to let them out of the lease, that's fine. 2, he can sublease it if he can get someone to move in there. Though the apartments may not want someone to sublease because they want to hold you there. But hey, talk to someone if you know them and say, you know what, I have 3 months to go and I'm moving into a house. Can you take over my apartment? So once the lease is over, you give in your termination notes and ask this person to reapply. So once they start looking for a house, they find one, give it about 2 months. The way things are right now, because of COVID, give it about 2 months. If there was no COVID, it's about 30 days. But because of COVID, it's taking a little bit longer. So you start looking for a house. How do you start looking for a house? You have to see. Let him tell you what they are looking for in a house. They will tell you a location. I want to be near the hospital. I want to be in this place. I want to be in this place. Square feet, minimum square feet. How many bedrooms? How many bathrooms? Where is it going to be located? By the lake. Doesn't want the lake. Near freeway, not near freeway. Then at that moment, you start looking, you send them some listings, they look at the listings, they narrow it down. The more you look at them, the narrower you get, and once you narrow it, you go look at it physically, because I may send you pictures, but pictures don't mean anything. What is being taken may not be the same, but physically, go visit the site. Once you visit the site, you look at different ones and you narrow it down to what you want. Again, there are so many things you have to look at once you go in that house. It's not like the building. No, you're going to look at several things. So once you narrow it down, then you say, you know what, this is what I want. At that moment, you send in an offer to the seller. Once you send in an offer, you ask for what you want. Some closing costs like we talked to. You may ask for a home warranty. A home warranty is going to protect the appliances, the heating, plumbing in the house for 1 year. So the seller is saying, is giving you a warranty, my things are going to work for at least a year. But after a year, you have to renew it or live without. So once you offer a contract, they accept a contract, you always ask for some time to do your inspections. Once you do your inspections and they're okay, of course you're gonna give them, they're gonna ask what's called earnest money. Earnest money means, hey, I'm really serious, I'm giving in something so that you can hold my property. I mean, you can take off the property and I do my inspections. So at that moment, once the inspections are over and you like it, you continue. At that moment, you open what's called title. You take that information, the title work, the title opens, looks into the deed, the commitment, the deed, to make sure it's free and clear. No liens, easements, minor rights, and stuff like that. So once it's free and clear, they'll give you what's called a title commitment. Once you're given a title commitment, that's what you take to the lender, and the lender starts processing your paperwork.
Thank you, Patrick.
Jimmy,
Yes,
can I supplement real quick too?
Yes, sir. Yes, sir.
It also depends. If you're trying to move into a new house, as in building a house, and you are in an apartment, you have to be mindful about the time. and depends which builders you're going to. I've seen builders that take up to 5 months to build, as in for the house to be ready to be moved in. I've seen builders who build in as short as 3 months. So if you're leasing an apartment and you're thinking about not renewing your lease, I suggest that you have to be mindful of all these things and know that, okay, I'm not going to renew this lease, but what is it exactly that I want to get? If it's an existing house, you don't have to worry about that. But if you're going to build, you have to be mindful about those extra couple of months. And sometimes your lease may be up. You may have to do a month to month, maybe for a month or two. But basically, you have to be mindful about what you're trying to get into.
Let me bring Mr. Anis Kalibara here. We have, if I have a house right now, and I want a second house or a third house to invest in, to use it as an investment for rent or for sale, whatever it is, does the law permit me to do that in terms of the loans that I get if I'm using government loan or any other type of loan that was being mentioned before?
If you are allowed to have as many houses as you want, but if you have a house you are financing with a bank and you did FHA loan, I don't think you can buy a second house. But if you have a conventional loan, I believe Patrick might tell you, you can buy a second house. But in most cases, for people who want to buy a second house, you just have to put more money down on the second house so that you can be able to finance through as an investment house. I don't know if I confused you there. What I'm trying to say is if you have a house and you want to get another house, the answer, yes, you can do it, but it's going to be an investment house, in which case you're going to need more money down to qualify for the loan.
Okay. How about...
Yeah, let me add on to that a little bit.
Okay.
Yes, like Mr. Anes says, yes, you can buy a second home, but it must have a distance. They must be a distance apart. You cannot buy two homes in the same subdivision because it won't serve the purpose. You live in this subdivision. Why are you buying a home in the same subdivision? If it is an investment property, yes. But if it is a second home, no. If you want to buy a second home, it has to be a distance of about 20 to 50 miles apart. But again, some lenders don't know, they don't care about it. I mean, it's put in the guidelines, which are written by Fannie Mae and Freddie Mac. But some of these lenders don't care. They may say, yes, I live in Sugarland, but I work in the woodland. It takes me almost an hour or 2 hours in the morning to get to work. So you have to write an explanation that, you know what, where I live, I have to drive for 2 hours to get to work. And that time they will let you buy a second home.
Mr. Josh, there's a question here.
Excuse me, sir. Can I ask a question?
Yes, ma'am.
This is Mrs. Tata.
Yes.
Okay, so we are first home owners. How would you say first home owners? Now, assuming that we want to move to a second home. First home, of course, we had the what? Homestay. Are we allowed to apply for the second home?
For homestead.
For homestead again?
No. You can only have homestead on one home, which is your principal residence.
Which is a tax benefit, so you cannot have it on two residences.
Mm-hmm.
Is that okay?
Thank you. Got it.
All right. So, Josh, here's a question for you. Please shed light on PMI and how to get rid of it from one's monthly payment so as to reduce monthly payments.
Okay, so PMI is a private mortgage insurance. Basically, PMI comes into play when you're putting down, when you're buying a house usually on conventional loans, you're required at least to pay 20% as a down payment for you not to be, pay PMI. So any time you're putting down, let's say you're putting down 3.5%, you're going FHA, you're putting down 3.5%, which is less than the 20%, you're going to be required to pay PMI, which is basically an insurance for the loan that you're getting. So in order for you to break out of PMI is one, either put down 20% and you just pay your regular principal, interest, taxes and insurance, or at a certain time, whenever you build equity up to 20%, you can request that PMI to be taken off. So let's say you've been paying on your mortgage, you've been paying PMI for the last 2-3 years, and you've built enough equity to bring you to that 20%. At that point, you can request the PMI to be taken off. Some mortgage companies, and Godfrey can probably chime in on this, it will drop off at 21% automatically. But basically, those are technicalities around PMI. It's just an insurance. It's the cost of you borrowing the money. Anytime you put down less than 20%, they're going to hit you with a PMI.
Yes. As Josh just talked about, it's true. That's the PMI. The rule about it, you've got to apply. If you don't, you pay for the rest of the life of the loan. If you don't apply, you pay.
Yeah, that's true. Oh, he's still talking.
You've got to apply. When you think you've reached a threshold, you've got to apply for it. It's one of the free money that mortgage companies get without you knowing. Right, I yield.
Yeah, basically, I'll add on what's called PMI. If you're buying an FHA loan, it's called mortgage insurance premium. Because you're putting down 3.5% and your credit score is a little bit lower, FHA says, FHA does not issue loans, first of all. FHA just guarantees that this person will make payments.
All right.
They do not issue loans. They just guarantee. So at that moment, they will say, we're going to take, are you there?
Yeah.
Yeah, they will say, yes, we're going to need you to put down 3.5%, but we're going to charge you 1.75% of the loan upfront. So if your loan is $200,000, they'll add 1.75% of $200,000 into the loan. So your loan amount will be higher than what it would be if you're doing a conventional loan. So they're going to add in 1.75 and they're going to charge you every month 0.80 every month. And that is going to be charged until the life of your loan. If your loan is 30 years, they will charge those until 30 years. So what are you supposed to do? You start with a lower credit score. If you improve your credit score to 700, my advice would be to refinance, get out of the FHA loan, and go to a normal convention. Because a normal convention, they're only going to charge you private mortgage insurance. But when you get to 20% equity, it's going to drop off. So assuming the norm is 11 years. After 11 years, it drops off. But FHA is for the life of your loan. So what do you do? Okay, so what do you do? Once you think you have collected enough equity, you can refinance. The only trick is some lender will come and say, yes, you can refinance, but there's no appraisal. You don't have to pay an appraisal. At that moment, they want you to refinance on the old value, so you have to insist that, no, I want an appraisal so that I can know the value of my house. It was 200, now it's 300. So the mortgage, the equity is there, and they won't charge you mortgage insurance.
Thank you.
Let me add on that one, Jimmy.
Okay.
For some of the people who want to avoid mortgage insurance, there are loan programs that do not, they don't charge for mortgage insurance like USDA. So what you do, you just buy a house in kind of a rural area where USD can finance, and you don't have to worry about paying mortgage insurance. And I understand that VA loans, they don't have mortgage insurance.
Thank you. Miss Joba Omago, are you there? Yes, go ahead.
So yeah, my question was about, okay, I'm taking you back to the requirements. So we have some of our friends who are self-employed, like the hairstylists, like, you know, they work from their homes. So I was just wondering, because today I was talking to one of my hairstylists and she was asking, hey, I need to get a home, but I don't have credit score. I told her, hey, do credit score, get like 4 credit cards, or if at all, go to your bank, go to a credit union and get a credit card. But then she said she didn't have, she said about down payment. I thought, okay, of course you need to have some money down. So start saving up now. But then when it comes, because one of the requirements that panelists said was about a stable employment. So my question is, for someone who is self-employed, they only get cash, and just the high, they don't have income statement. How do they go about that? They need to own a home.
Yeah, on that, Jovi, I'll try to give you a little bit of that. If they do not have a down payment, one, they can try to get an FHA loan and ask the seller to give them 6%. So the 3.5 will be the down payment, then 2.5 will be applied towards their down payment. So they're gonna come up with a little bit lower than that. 2, if they don't have no credit, yes, they can take what's called non-traditional credit. What's that? Non-traditional credit will be your rent, your cell phone, your rent, electric bill, insurance, car insurance. And some people will have other things that you pay on a monthly basis. Basically what they will ask you is, hey, can you give us what's called a 12-month history of your rent payment? Go to your your apartment, ask them for 12-month history. Make sure you don't have any late payments. If you have late payments, it cannot work. Same thing, you go to your cell phone, ask them for 12-month history. You have late payments, it's not gonna work. Third, you go to your insurance agent, ask them for 12-month history. And once you collect, if they ask for 3, you give them 3. If they ask for 4, you give them 4. At that moment, they will say, oh, this person has been making payments on time. He may be a good client when things have worked. Now, on the self-employment, yes, if they are self-employed and they have been making taxes, they have been paying taxes, that's good. They'll have to get their tax returns. The only drawback with we people who are self-employed is very careful. I'll say, you know what? I made $200,000. I will brag, I made $200,000. Then he wrote off $170,000. At that moment, he only made $30,000. So the lender will look at it. You know what? He only made $30,000 divided by 12 is what? $2,500. They'll give you some other little allowance that can be added in there. But the norm is you made $100,000, you wrote off $70,000, you end up with $30,000 divided by 12. That's your monthly income.
Thank you,
that's
sir.
One. The other thing is, yes, there are lenders who are not going to care. They will say, you know what, just send me a profit and loss. You are self-employed, send me a profit and loss and 12-month bank statement. 12-month bank statement. And in that, it will be called a bank statement loan. So you give them 12-month bank statement. What they are looking for is the deposits that were deposited in your bank statement. They will add up everything, come up to $200,000. Those were the deposits. They don't care about the withdrawals. What they care for is the deposits. If it's $200,000, divided by 12 if they want a 12 month, or divided by 24 if they want a 24 month bank statement. At that time, that would be your income to use. The only drawback, you're not going to get the same interest rate. That's the only difference. If you're first-time home buyers, you're crying for 2.5% interest. No, it's not going to work for you. The interest rate will be a little bit higher because these are not normal loans. They are non-QM loans. I yield.
Jimmy, let me just, Jovia, now the first thing again, I'll ask your friend to get pre-qualified. There's programs around the city. Harris and Fort Bend do this. There's down payment assistance programs. You can get up to $20,000 if you're qualified, but you would never know that you're eligible for some of these grants until you get pre-qualified, you know? So just ask them to go get pre-qualified, and then like I've seen builders who can contribute up to $10,000 towards closing costs, you know? So you have closing costs, that kind of mitigates your out of pocket, you know? So if you're qualified for down payment assistance and you're going with a new builder, because builders give incentives, they want people to come into their new subdivisions. You have a 10,000 here, you know, already you have a 30,000 that you're working with. So you can work some, and then if you're in a USDA agricultural area, and by the way, Cyprus here, there's properties designated as USDA. You can apply for a USDA loan. 99 and Katy side, all that area, it's USDA eligible. So I would say have a get pre-qualified. You can never know until, you know, you start the process.
Okay, we have about...
I'll add on a little bit on that. Yes, Mr. Aksui said, yes, there are grants that are being given, but those grants are geared towards the government or housing and urban development. So if you cannot qualify for the credits, you are wasting your time. What they'll do is they'll tell you, hey, you want a grant or you want down payment assistance, fine. You have to go to a class. Some of them say you have to go to a class. They're not going to tell you the end part of it. You have to go to a class, you pay $40, you make arrangements, you go to a class. At the class, there will be someone to pull your credit. If your credit is less than what they want, I mean, you paid, they'll let you go ahead. After doing that, they say, oh, you need to go to a credit counseling service to counsel you about your credit. Or they'll say, oh, no, you don't have enough credit, you have to go and improve your credit, but you have already paid your $40 and you wasted your time going to a class. 1. 2, yes, you want a grant or you want a down payment assistance, but the interest rate is not going to be the same because there's no free money there. I mean, people may say it's free, but in actual sense, it's not free. They'll say they dictate the interest rate. If you are getting 2.75, you go get a grant or a down payment assistance, you are not going to get 2.75 because they have to make that money to put back into the pot so that they can give it to another person. So if they say the interest rate is 4.5, that's what they'll charge you. You cannot say, oh, the other people are getting 2.5. No, it does not work like that.
It's raining outside.
Thank you. Thank you, sir. Okay. Now, quickly, gentlemen, we have about 3 minutes, and there's a question that's pertaining the city of Houston. Number one, we all know that Houston has floods, and a lot of members who are getting homes right now, some of them don't even know which locations are there. And we don't want any member of the Houston Ugandan community to be put in a flood zone. So, gentlemen, the 3 gentlemen, we want you to be, one of you can give us clearly, how can these members avoid such areas, especially here in Houston and surrounding areas?
I think Godfrey has a good answer.
No, I just want to, if somebody could also pick up Mr. Sonko's question too. There's a question from, before we wind down. Mortgage.
Okay.
Yeah, I'll give you an answer on that.
Yes.
What's the difference between what a mortgage and the rent to own? That's a question?
Yes.
Yeah. The difference is if you're trying to buy a home, you're gonna apply for loan, and once you apply for loan and the lender approves it, at that moment you'll have what's called a mortgage on that house. Now, if you want to do what's called rent with an option to own, in other words, it's not a government thing. It's between you and the seller. So the seller will come and say, you know what? Yes, Mr. I have my home here. I want you to rent with an option to own. So you're going to come up, draw what's called an agreement. He'll come back and say, the rent is $1,200. Now, he's going to put certain terms. He said $1,200 per month. You're going to pay for 8 months. And at that particular time, after 8 months, you have to turn that home into your own names. The drawback is you have to be very careful. If you have a rent with an option to own, make sure he's the right person. You don't want him to say rent with an option to own. He goes back and borrows against that house when you don't know. Because once you get a mortgage, you'll be showing more than what you may have decided. I mean, what you may have done earlier on. Now, is it a good idea? It's good, but at times I would advise you to get to an attorney so that they can draw up an agreement in the rightful manner. Now, if 8 months comes and you don't fulfill what the agreement said, he can say, no, I'm not selling it anymore. He looks at the values have gone up and he had given you the home at a lower price. Now, his only recourse is to see that, oh, I wish this person would miss the agreement by 1 day or 2 days. He can say, no, I'm not selling anymore because you didn't fulfill the agreement. You even made a late payment at the last time. So he can say, no, I'm not selling it anymore.
Okay, thank you. Mr. Kalibala, are you taking on the flood district, flood area?
Right now, there are new forms which shows what area flood. But as long as you live in Houston now, we don't take it for granted anymore. We just advise everybody to have flood insurance in possession because we never know where it's going to flood. Until such a time when we're 100% sure it doesn't flood, it's just right to tell your client to buy flood insurance. Because the new map that came out for flood insurance, everywhere in Houston, almost everywhere in Houston floods.
Do you have time for one more question?
Yes, ma'am.
Yes, we can take that.
Jimmy, I can stay on if you want to stay on. If there's people who still have questions.
I also raised my hand 30 minutes ago. I had some questions.
I didn't see. So let's agree here, gentlemen. We are ready at 6:23. Can we all agree that we can give it maybe 10 minutes and we conclude, or?
Well, we can stay forever.
No. We can't stay.
I don't mind. I can stay. Jimmy, I think let's give it to the people because I feel like we've been talking a lot. Let's give the people an opportunity to ask their questions.
Yeah, but up to what time? We can't stay forever.
We shall pay for it. Why are you crying?
Okay, 10 minutes. Let's work on 10 minutes.
Moderator.
Yes, sir.
Let's post the questions. Then you read it out and it's one by one. If that's okay.
I posted mine already.
Oh, sorry.
Just ask it. How about ask it?
Ask it. Go ahead.
Oh, sorry. Okay, I'll go ahead and ask the question. Is it possible to switch from a 30-year mortgage to a 15-year mortgage? And what's the process? Can you explain the benefits of a 15 versus a 30-year mortgage?
Yes, you can switch from 30 to 20, 25, 15, 10. There's no objection with that. If you can meet the debt ratios, it's not a matter of saying, you know what, I was paying a 30-year mortgage, but I want to go to a 15. They're gonna underwrite it like a new loan. If your debt ratios are way out, they're not gonna let you do that. It has to be within the guidelines.
And I think
now, the other question is,
what are the benefits?
Let me finish. The other question is it advisable or is not? So when you're doing these loans, if you're doing a 30-year mortgage, you are getting a lower payment. If you go to a 15-year mortgage, your monthly payment is going to be higher. I know the term is less, but the payment is higher. Now, the interest is going to be a little bit lower because a 15-year mortgage. Now, my advice would be, is it worth it? You have to sit down and compute everything and see if it is worth it. Because if you are a 30-year mortgage and you are paying $1,000 a month, let me say most of the month, let me 50% of it may be going to interest. Then the other one is going to be subdivided into goes the principal, taxes, and mortgage insurance. Now, if you go to a 15-year mortgage and it's going to go to around $1,300 or $1,400, still, most of it will be going to the interest that the lender takes. Now, my advice is, if I sit down with you, I'll do these figures for you and tell you, yes, why don't you do a 30-year mortgage? But you have to be disciplined. That's the catch. So you do a 30-year mortgage, you're paying $1,000. You do a 15-year mortgage, you're paying $1,400. So the difference is $400. So why don't you do a 30-year mortgage? Pay the $400, which you are going to pay towards a 15-year mortgage. Pay the $400 towards your principal. So at that moment, every month, your principal is being reduced by $400. So in the end, you're going to end up by doing slightly the same or a little bit better than doing a 15-year mortgage. And remember, doing a refinance is not free. It's going to cost you the same money like you are buying. And it's taking you backwards. So you're going to add almost 5% into the loan. That's a closing cost into the loan. You have to do an appraisal. You have to pay the title company. You have to pay the origination fees. You have to pay lender fees. So all those are going to be added into your loan. So it's not free. But if you want more information, yes, just give me a call. I'll do some figures for you, and you can make your determination at that moment.
Thank you. Mike,
okay, this is Mike.
Mike.
Yes. Yeah, thank you so much. I want to thank the organizers of this meeting. It is a very educative meeting. My questions are general questions. One, what would be your advice for a first-time home buyer who wants to buy a house but has questions between buying a new home or a used home? That's one question. Two, what will be your advice for someone who has a business and also owns a home but wants to make his or her home the business? What are the advantages of that? And I think those are the two questions. Thank you so much.
I'll answer the first one, which is either one buying a used home or a new home. What are the advantages? Am I right?
Yeah, go ahead.
Okay. Yes. What's the advice on someone buying either a new home or a used home? Yes. That's a very, very large question, and I may not answer it fully in the little time that's given. But again, most people say, no, I want to buy a new home. I'll start with a new home. I want to smell the paint. That's good. Yes, you can smell the paint, but there are certain things that you have to know. You as a first-time home buyers, you go to the lot, you're gonna go to a spec home, I mean a model home. You go around the model home, you see what you want to see, and say, oh, this is what I want. You'll be surprised that if they build the home, it'll be totally different from what you saw. It's not gonna be exactly the same because in the model home, there are so many upgrades. So it's up to you and you're a realtor when you go to that home. Ask the salesman, what are the upgrades in this home? Then they'll give you a list of upgrades that were put in the home. Then at that moment, ask them what are the prices, or you don't know the prices, but when you decide you want to buy it, he will start adding those into what's called a best price. All of them will have what's called a best price on that home. Then you'll say, no. Me and my wife, when we saw the property, they were stainless steel appliances. Oh, sir, that's an upgrade. How much is it? Oh, we have a package for $5,000, includes a fridge, a fridge, stove, and a microwave, $5,000. But because you went there with your spouse is, hey, baby, I want that, so they'll add $5,000. 2, you go to the floor, it has wood. What they're giving you is mere carpet. And your madam says, baby, no, that's what I want. How much is the carpet? $8,000. Add $8,000. Cabinets. These are the norms that people cry about. Cabinets. Or what we had was maple. No, I want better than maple. Or cabinets, $3,000. Oh, baby, I saw raised, the doors were raised. What they are giving you, the flat doors. The doors are raised panel. You have 12 doors. So they will add up 12 doors at $400. I don't know how much that is. You go to the master bathroom, the master bedroom, that's for the ladies especially. They go there, they look at the closet, the tub and stuff like that. It's different. Oh, I want this, I want knobs, which are better than what they're giving us. Hey, all those are upgrades. So in the end, the house is gonna cost, it's gonna cost way more than what you wanted. Now, is it good to buy a new home? Yes, it's very nice to buy a new home, but how do you buy it? When you go in a subdivision, look for homes, ask for what inventory homes they have. He'll give you a list of inventory homes if they have. Those are the best homes to buy if you're buying brand new. Inventory homes. So when the builder starts building, he's building on what's called a construction loan. He's not paying interest until the home is ready to move in. At that moment, when the city certifies it, then the builder starts paying interest. So if the house takes 3 days on the market, he starts crying, oh, I'm losing. Then when you come in, they are willing to discount that home as much as they can. The other thing is, we realtors are paid by the builder. Let not your realtor, maybe me, Josh, Ernest, or another person. When you go there, at times we don't want to negotiate because we are being paid by the builder. If we negotiate, then the builder will be made. So we tend to give you to the builder, to the salesman, so that the salesman can chisel you. No, I have a right to say, you know what? You are asking us for $300,000. We are giving you $250,000. You'll come back and say, no, that's too little. Hey, let him write a contract and send it to the head office. Let the head office decide. Because the builders have a certain percentage to play with. They're not going to tell you, but I know because I ever sold somewhere. They have a certain percentage that that's given to you, that's given to them to discount that home. If it goes beyond that discount, then they have to send it to their managers to decide. So the other thing is, you don't know, when you buy a new home from scratch, you don't know where it's located. It may be located in the back of the subdivision. because we don't know. But technically, when they're building homes, they always start from the back of the subdivision. By the time they come to the end, the price has risen way, way higher than what they had. Now, that's on the new home. Use the home good. If you get a home that was updated, upgraded, when someone bought it, he upgraded their house, it's only 1 year or 2 years or 3 years, yes, it's still good as a new one. It's already upgraded. So to me, you can buy that home and you're comfortable because it's already upgraded. It's in a corner lot. It's in somewhere else or whatever it may be. So those are my questions. It's a lot to explain, but I can't finish it right now.
Let me add
Okay,
on.
question.
Can I add on something?
Yes, sir.
Okay. Always, this is what I'm thinking. You go into buying a house because it's an investment. Usually, when somebody sells their house as a used house, they're going to take out all the equity. And it's going to take a long time for that equity to come back. That's why I advise people, if possible, you buy a new house and you start building that equity. So by the time the neighborhood gets old, you have enough money instead of going to a used house where the equity is already gone. That's the way I look at it.
Thank you.
Yeah, I'll add on to that, but if it's starting, that's good. If it is closing, no, because, hey, the builder has only 2 homes and he's pricing it maximum. If it is starting, that's fine.
All right, Mr. Pixel.
Jimmy, there's another part to the question. I think Mike asked about if there's any incentives in having your business at home. There's some tax write-off exemptions or benefits you can. I suggest you have that conversation with your CPA, but you also have to be careful in what kind of business it is. You have to make sure that you're city compliant with city codes. You can't just put a kitchen in Midtown somewhere in a district where it's purely a residential and you're not allowed to have that kind of permit in there. So those are things that you always have to do your research on, get with your CPA. There's definitely a lot of benefits with doing business from home.
Let me take help Mike with that. What happens is if you have your office at home, the kind of businesses that you can do at home. And again, when Josh talks about licenses, city codes, something to do with food, of course, there are so many questions about that. But let's say your insurance company, you have an insurance agent, you can have a room in your house that you use as your office. Now, all the bills in your house, you'll have to get the square footage of how much your office is. Then you write that off as a business. That's a Schedule C. You file that. So all the bills, everything in your house, you have to divide between your residence and your office. Those are the benefits. I yield.
All right, Mr. Pixel. Somebody called the Pixel. Please ask your question.
Hey, Mr. Jimmy, this is Data here. I have a question.
Yeah, go ahead.
Yeah, my question is regarding the interest rate. You got, I heard them talking about the interest rate. How is the interest rate determined? Is it determined by your credit or with the market, with the current market which is going? For example, right now, we know that the interest rate is low. So if you are going to buy a house, is it determined by your credit or is going determined by the current market?
I can take a take on that. It's both. There's always going rates. Right now, generally, interest rates are low. There's actually projections that we might go into the 270s. Who knows, with the effects of COVID and the unemployment that we're going on. But also, your credit affects how much you pay to borrow a loan. So if someone goes to a bank and their score is $700, they're not going to charge them the same interest rate as someone was $450 or $500. So it's those two factors come into play. It's whatever the going rate is in the market, but also your credit score affects how much your interest rate is going to be.
Yeah,
so the higher the credit score, the more likely you are to get a low interest rate when you're borrowing.
Yeah, I'll add on to that a little bit. Yes, like Mr. Kisuli is saying, yes, your credit is a determining factor in getting what interest. The down payment, like he says, the debt ratios, the lower the debt ratios, the better. If you have a higher debt ratio, you're going to get a higher interest rate. Down payment, if you have two people, one has 5%, one has 10, all of them have a credit score of 750, they are not going to get the same rate. Obviously, the one who has a higher credit score will get a better rate. Then the one who has a lower credit score is going to get a lower rate. The one major difference is FHA may be general because they're a little bit lenient. But when it comes to conventional loans, hey, if you have, I know the minimum is 620. At 620, it will be very, very hard for the mortgage insurers to insure you. So most lenders are not going to want even to touch you, or they're going to charge you very, very high, like 2.49, instead of charging you 0.8 or 0.59. If you have 720, the norm is about 0.59 in mortgage insurance. So that's the catch right there. They may finance you, but your mortgage insurance will be very, very expensive. Again, mortgage insurance protects the lenders. It's not to you. Mortgage insurance just protects the lenders. In case there is a foreclosure, the mortgage insurance will pay the lender, then they will take the property, and in end, the property is going to turn up as a foreclosure on the market. So, credit, down payment, debt ratios play into what interest rate you get.
Jimmy, can I say something real quick here? There's a lot of sites that offer free credit score information. You have to be careful with that. The major credit companies have certain algorithms they use, and sometimes there'll be a major discrepancy. You pull your credit on some comma credit score, whatever, it tells you 700, all of a sudden you go to a lender, they tell you in the 640s. It's because they look at different things, different algorithms. FICO and Vantage, those are the two popular scores that lenders look at. So people have to be careful in when they say this is my credit score, you have to know where you're getting it from and what kind of score it is. I would say FICO is the more popular one.
I'll add on that a little bit. Yeah, whoever is using Karma Credit, that's just a general thing. It does not factor in mortgage liability. That's why it gives you a higher score.
Okay, gentlemen, as we speak right now, we discover there's a lot of information that we all still need. And I can promise you that we'll be bringing this topic back again, because I know when we get into the area of investment, we have real estate there. So the three gentlemen that are there, we promise that we're going to be bringing you back for this kind of topic to discuss it. As far as we are concerned right now, we want to be very grateful for every one of you, especially the panelists, for presenting whatever you presented to us. With a hand of applause, I would like us as a community, let's appreciate these expertise of men like these for the work they have done for us. Let's give them a hand clap. Thank you, gentlemen. And for the audience, for the community of Ugandan Americans, you got to learn that word again. We're going to be having different topics to discuss. And when we're discussing them, that's why we are asking you to deliver whatever you think you want to be discussing in the community. We want to discuss it. Why? Because as we go ahead in probably 2 to 5 years' time, we want our money, whatever money you get, to move about 5 times in the community before it leaves it. Now it can only work when we have people who are doing certain things. A good example is the real estate industry. You have a mortgage, you have realtors, you have appraisers, you have whether it's anybody who is cutting grass that can keep the money within the community for some time. And that's what we are targeting. In all this that we are doing, we want to keep money in the community. Let the money move in our community before it leaves. So as you have seen, the three gentlemen who are here, there's no good reason for any of you today to move and look for a Chinese realtor or an Indian loan officer or a Nigerian appraiser. You don't need to, because we have certain people in our midst. And so, gentlemen and ladies around, we're so grateful. We are hoping one of the days we're going to have a lady realtor too. And hopefully one is coming soon, who is a Ugandan American. So that we balance out. We don't want to be imbalanced in this.
Hey Jimmy, real quick, if anyone is interested, I can put my information there. If anyone is interested in a home buyer's guide, basically a roadmap to, getting a residential home, I'm going to post my information. They can text me or email me. I'll be more than glad to share that to them.
Thank you. And I already sent it there. I sent you.
I'll add on something, Jimmy, a little bit. Yes, because credit is the major factor when you're buying a home. I can give advice to whoever wants. If they can get in touch with me, I'll give them advice. And the other one is, generally, cleaning your credit is not something very hard. It's a very simple thing you yourself can do rather than looking for a credit repair. What a credit repair is going to do is exactly what you can do.
Thank you. Okay, finally, gentlemen and ladies, no, ladies and gentlemen.
Jimmy, I have an announcement too. Hi.
Yes, Maureen.
Yes.
No, she's muted.
Okay. Maureen, unmute yourself.
Unmute.
Can you hear me now?
Yes.
Ma'am.
Okay, so Jimmy mentioned that hopefully a lady realtor will come through. I'm not a lady realtor in the making, but I'm a lady loan officer in the making.
Nice.
No, you're welcome.
Great. Thank you.
Thank you.
Let me add
Yes.
one thing. Those of you who don't have credit or self-employed, we have programs we can put you into getting a house. Don't get despair that you cannot get a house. Just get in touch with us. We can show you how.
Thank you.
Okay. Mr. Jimmy, one more thing before these guys leave. One more thing.
Yes.
What advice would they give to our community members who have double income? Maybe they make more than $4,000, but they're still in the apartments, but just fear to get a house. Also, what advice will these gentlemen give to our people aged between 25 and maybe 40 who are making $40,000, but are still in the apartments? What advice will they give to those kind of people? Thank you.
I thought Mr. Kisule handled that.
Yes.
Yes.
Mr. Kisule handled that that aspect. But gentlemen, we're going to be discussing all that. But here is the last question or last announcement for you. One big deal that we need for us to succeed in this program, we need to register. All Ugandan Americans must be registered. When we are registered, then we know what potential we have in the community. So every one of you, please go to the website and register yourself. We need registration. Don't pay no fee. We're not asking for any fee. We just want you to put your names there. Why? Because there are a number of programs that are coming to Houston and they need to know our population. We're going to be having a number of programs that are coming in. So every one of you, wherever you are, please register. Go to the website and register. And that way we'll build up the community that we want to see in this city of Houston.
Hold on a second.
As I speak right now, there's no way we can finish this topic. We can go with this topic up to tomorrow, but I promise that we'll bring this topic again for discussion. Secondly, next we wanted to find out how often do you want these topics to come? Because there are different things to handle. And on our list, we have the children going to school, the complication with this COVID-19 that is causing a problem with the education system is going to be our next topic. And so we want to see whether it's the bi-weekly or monthly or something like that. And so every one of you, please respond in the WhatsApp group. Write back and give us your opinion. Finally, I want to give Mr. Chairman, our chairman is Godfrey Toli, and we have a committee members whom he probably has to introduce them to. So, Godfrey.
All right, thank you all from the chair for attending this meeting. I'm glad that we're able to have the discussion, and it seems there are a lot of questions. There are lots of questions, but we have a very good resource in our midst, the three realtors. Now, today we covered basically on home ownership, that's personal residence. But the more education we get about it, to give us way how to start getting into investment properties. Because the next step you will look at is after getting a home, because America practically was built on real estate. What happened, if you look at the red line, those what they call red line, there's some areas that is not lend money. And you won't believe that some of those big houses you see in New York that are costing about 3, 4, 20 million, 30 million. People got them at less than 100,000. Strictly they were lending to whites. Blacks were excluded. And that's how the white community built on their houses, the money.
You can't say white
community. It helped them build money for businesses. And that's the equity the realtors were talking about. They borrowed that money and opened up businesses, and that's created a lot of wealth for them. It's the same thing that could also happen to us if we get to understand the basics. And we have a very good resource, always refer to our realtors. They're really a very good resource to us. And I'm glad to be part of this community, and I'm looking forward to working with each one of you. And I would like our publicist to say something. He's been so quiet in the background. Mr. Bali. Mr. Bali, could you please say something?
I'm trying to unmute. Thank you, Mr. Chairman. Thank you, Jimmy, our Vice Chairman. Thank you, the three realtors, Mr. Joshua Chisudi, Mr. Patrick Wandera, Mr. Anes Kalibala. You've been great. And we are so happy that we have you. And now we've just been introduced to a new resource. We're just about to have Miss Maureen, who's coming in as a loan officer. You're most welcome too. Hopefully, at one day in the future, I envision a Ugandan American real estate company run by you guys. If you can put our heads together, that would be wonderful. Like Jimmy said, we have a few things coming in over the next few weeks and months to come. But it all depends on what kind of response we get from the community. Allow me also to thank Mr. Mike Mukasa, who has so much helped us get some information from the main organization, from the Uganda National, the UNA group. So together, collectively, we can make it. And today I've been very quiet because I'm not an expert in that field. I've worked in that field before, but I should be humble enough to say those are the three experts we have. We should listen to them. Over to you, Mr. Chairman, in the interest of time. However, Mr. Chairman intimated on the point that how often can we have these going? If we can determine maybe bi-weekly, that'll be sweet. That'll be wonderful, because information is needed across the board. Some things you know, some things I don't know, some things they know, something other people don't know. We need to crisscross each other's ideas and pull them into one source so we can be more informed. The more informed we are, the stronger we become as a community. I yield, Mr. Chairman.
Thank you.
Thank you. Can we have who are members of the committee who are on, please? Brenda, I see Brenda is on.
I'm here.
Yes. Thank you. Who else is on?
I'm on too. Sorry, I was on mute.
All right, Brenda.
I'm
That's our
still
secretary.
Yes, also, actually, I wanted to mention I'm also a licensed mortgage originator, and I have 10 years of mortgage experience, processing, refinance. I've done all that, so if you need anything, just let me know.
Can you share your information?
What kind of information would you like?
On the on the chat side.
Okay.
Everything. Yeah.
Contact? Yes.
Make good use of the WhatsApp group.
Okay.
And besides
Mr. Joshua is asking for name, number, and all the,
Yeah, basically, if we have business, we can refer it to you.
And I also, all these sessions are being recorded, by the way. You can go back and watch and go through it. Everything is being recorded. Okay. We have Mr. Kaya, who is our expert in IT, so he helps us a lot. We're very grateful for him being able to acquire this account for us and organizing and keeping records for us. And also he's encouraging each one of you, please. There are also emails. You could also get emails from the HUC community. That's if you go to the website and register, which has been put out there. So please register so that you can get more information about what the community is doing. So thank you all. I yield back to Vice Chairman as he organized it so he can.
All right. Thank you so much, everybody, and let's meet next time. We will continue communicating in the WhatsApp group. Thank you very much.